Welcome to Keen on Retirement, a show dedicated to helping you thrive before and during your retirement years. If you are looking to grow and protect your wealth and want to make the second half of your life the best half, then listen in as Wealth Advisor Bill Keen sorts through the key issues that you need to know in a lively and candid way.
Hello, everybody. Welcome back to Keen on Retirement. I'm your co-host, Steve. I got Matt and Bill with me today. Gentlemen, how are you doing?
Well, we're doing good here, Steve. I was just noticing as we went live, asking a little bit before we went live, we've got three different dress kind of codes here on the screen. So we've got Steve, which has got a nice button-down collared shirt. I mean, you call it casual, maybe business casual, nice shirt. It is very nice, very pressed. Always look dapper. You got Matt with a nice business shirt and a tie. And then you got me. For those of you on YouTube, you can see, the other listeners will see, I've got it still. I'm still hanging in there with a nice jacket, tie, and a pocket kerchief. What do you think about that? Is it just, it's got some diversity on the program today with the dress at least?
We do. And I don't know, what do you think that says about our personalities or our demographics here?
Well, you can't see what pants or shorts anyone's wearing, so who knows? Maybe
I am in office today. Steve's at home, so it's a home office, I should say. Yes, very nice home office.
We're only going to show me from the waist up here.
Well, I will admit, full disclosure to our audience, I have shared about my knee quadricep tendon. So when I was down, I do have a home office at the home studio, which most folks didn't realize I was recording from the home studio. So there were times that, I did not have the suit pants on. Of course, I had that brace thing on, right? During the episode. But I did, did show up well for the program.
So how is the leg these days?
Well, you'd be happy to know I met with the surgeon just this morning, and I've got a nice connection with him, Dr. Cullen, there out at a place called Sano, a nice gentleman, very, very sharp orthopedic surgeon. We had a nice connection on several things, several fronts, and including the fact that he helped me a lot with my knee. So it was 6-month checkup today, and he was super happy. He told me I didn't need to go to any more PT, Matt, just so you know. I don't need to go there. Of course, I do my workouts. So I do the stretching. I do the weights. I'm starting to, get back into it. He did tell me 3 more months probably until I go play tennis again. So that would have been 9 months from that. And he said, you're probably, honestly, when you have a traumatic injury like that, you probably will never play quite as intense as you did before, because it just is in your brain. Mm-hmm. You just remember what it was like to go through something like that, which really makes it interesting for professional athletes that have to get over that when they have something that traumatic and they have to go back and play 100% or 100% plus.
Sure.
I don't. So I will let that ball go by that might require that extra step when I do finally get back out there.
Yeah.
Thanks for asking.
Here. Good.
Yeah,
well, I don't think Krista would want you on her team then.
No, Matt's been playing tennis up there as well. Hope you don't mind me sharing that.
Yeah,
Matt. And
getting back into it. I played when I was in high school, so yeah.
Yeah, and they play clinics up at the club. I need to go up and watch because Matt and Carissa, she told me you played again last night. You guys were on the same team a time or two as it rotates through, and sometimes you guys dominate. Matt's really good, though. He's humble, but he's a really good player. He's got some really good top spin and good serves and that kind of thing.
Yeah, it depends on who I'm playing. We'll put it that way.
Okay.
So who can beat, when you two play, who beats the other one?
I don't know if we've really ever played, maybe, but.
No, so what would happen back 20 years ago?
Well, I'll just hit drop shots now. You can't get to them.
Yeah, you can't get to them. 20 years ago, like if I was playing and I was in my prime, and he had just started back and he was rusty, he would hit out and, hit, errant shots and things like that. But once he dials down, once he gets back into it, dials in, he's going to pretty much beat me every time without question. Yeah, I'll admit it. I have no problem with that.
Humility is a good trait, Bill.
Yes.
All right. Well, we've got a good episode lined up here today. We're going to be talking about mortgages, particularly mortgages as you're in retirement or nearing retirement, or perhaps moving in your 60s to be closer to your children, like my wife and I did a couple years ago.
Yeah.
And I think maybe a fun way to start this is, if you guys remember, when you got your first mortgage, do you remember what the interest rate was on that mortgage?
Let's let the young guy go first.
Yeah.
Okay.
I'm thinking, I think it was in 2004. It was for a condo out in Lee Summit. And I think it was like 5.5. And it was an ARM, which was fine because I understood what it was. And rates had gone down. So when it reset, it went lower until I sold the place. So it actually worked out in my favor. But I think that's what it was. I can't recall exactly, but it seemed like in the fives.
Yeah. So mine would have been 1995. Isn't that interesting? Back in the mid 90s. And I remember earlier that year, like the beginning of the year, the rates were at 9%. And they moved down that year. And then toward the end of the year, when I finally locked, I think it was more like 7.7 or something. And that would be the mid, like 1995, 1996.
Yeah.
How about you, Steve?
Yeah, my first mortgage was 1990, and I don't remember the exact rate, but I know that mortgages back in 1990 were in the 8 to 9% range. But I typically would get the adjustable or the 5-year fixed, or a 7-year fixed, and then then it would adjust. And I think the short-term rates were lower back then than the long-term rates. So I'm guessing I was probably in the 6% range, maybe fixed for 5 years, and then it would adjust. And my most, well, not the current mortgage, but the one before this, the one that we left in Wisconsin, was a 3 1/8% rate, which was near the bottom as interest rates, got down to like 1% or actually zero interest rates.
Yeah.
But we had a 3 1/8 mortgage, and we traded that for a like 6 1/8% mortgage. So bad trade there moving here. So
you can't take them with you, can you?
They're not portable.
No.
Not portable. So we got I've shared on the program about the lake house, and this is on topic here as we share through this, our lake house that we got during COVID. Remember, we went down to the Ozarks and were able to purchase a pretty nice place before the real estate really just spiked up higher. I mean, it's been amazing what the real estate market's done at the Lake of the Ozarks. But we were able to, I put down a nice chunk, I think I might have put down half, even like 50% or something. But the rate's 2 1/4 on a 15-year, on a 15-year. So, But listen, the reason we're doing this today, our program, a lot of folks who have not been exposed to any type of financial planning or asset management, a lot of people are under the impression, or they haven't thought about it really, that there's a lot of aspects. And if you've listened to our program for any time at all, we've been at this now, I think in our 11th or 12th year, as far as the podcasting goes itself. I've been at it, 35 years in the industry, Steve longer, Matt close to 25. But a lot of folks just think their initial thought is in financial planning is just putting money in the 401k or buying a pie chart of mutual funds or something. They have really no concept, and which is no disrespect. They just haven't been trained on it, of all the intricacies that you have to think about that are financial related, that go into decision making and being a good steward of your resources. Oh yes, and the investment portfolio is a part of it. It's a part of it, but you might even say it's 1/10 of it. I mean, it has to work. It's got to perform. It's got to do well. But there are so many things, whether it's all the different aspects of taxes, how you're going to have health insurance pre and post age 65, whether you're self-employed or you're working for a company, estate planning, wills, trusts, how things are titled, how you deal with your kids, the thought processes. A lot of times folks realize when they've worked with us for a little while, they say, you are so much more than just dollars, dollar signs and decimal points. You are our thought partners on how you even think about wealth, and then all these different aspects to it. This being one that a lot of folks probably might not think about. They might not even know they could come to a firm like ours and get guidance and counsel on how this might work if they want to, like, let's say, buy a home once they're retired and don't have income anymore from a job. Or what if they want to put a down payment on a house for one of their kids? How could that work? I mean, these are all things that I think it's important to chat about. And a lot of folks maybe don't realize that there's a resource for it. And we look at all of it. We really do. So I like this episode. The other thing about it is we received questions quite a bit more recently. And we always promised, even on our first episode, Steve, that we were going to have a look behind the curtain of what we're seeing here in our firm and operation, and just bring it to the show and let folks get an idea what we're dealing with and the questions that are coming in. So I think it's great. I really do. Yeah. I'm glad we're doing this episode.
Well, yeah, let me start with this one. I'm not sure if this is what actually came in as a listener question, but I think it's right on topic here, which is how often, what percentage of your clients, most of whom are in retirement, what percentage of them actually still have a mortgage in retirement versus they say either, hey, I'm totally okay with having a mortgage in retirement, I'm going to die with a mortgage and I'm okay with that, or what percent say, I don't want to have a mortgage in retirement, period. I want to pay this thing off. What is that conversation? How does that go?
Yeah. Gosh, I don't have hard numbers on that. I'm thinking maybe this, we can each throw out a number here. I think we've probably got.
Hold on, Matt. Before you write that, before you say the word,
okay,
I'm going to go ahead and do the thing that we do. This is going to entice people to watch our Facebook program so they can see. I wrote down a number. I wrote down a number that I think are the percentage of people that have mortgages in retirement. I wrote down a number.
And this is Matt. For your clients, right? Your clients.
That's right.
This is for our clients. And again, this is not hard data. We didn't look this up, but it just goes from what Matt thinks. And I think, go ahead, Matt, I'll show this.
I was, because you got to separate, okay, how many clients are retired, fully retired? I want to say like 50%. That's the number that pops in my head.
Okay. All right. Viewers.
Hold the sign up, Bill.
Viewers, you will see this. Matt and Steve will verify what I wrote on the piece of paper without talking to Matt first. And I promise you we didn't talk about this because you threw this question out.
I just threw this out, right? Yeah. This is random. 50%. Look at that.
Okay. What do I win?
Wow. Yeah.
What do I win? I'm the one that wrote it down.
You guys get to keep your job for another year.
That's right.
We get bonus points. Yes.
Well, the data too around this, because so
I wrote down 50%, by the way, to the listeners. I literally wrote down the exact
you did.
Number Matt said.
I will verify that. I'm the impartial judge here. That
we always know, you just say 50% on hedge on everything, and you're pretty close. Actually, when we were talking about this and preparing for the podcast, I was looking at data on home buyers, and the median age of all home buyers is 59.
So half above, half below.
Yeah.
Okay.
59.
And then for repeat buyers, it's 62, age 62, of which 30% repeat buy, they paid all cash. So that means 70% is taking a loan of some sort. So the buyers are all basically at retirement age for the most part. And the median age of a new home purchaser, so first time buyer, is 40, which is, again, kind of why the question is, should I help my kids? Because you're less and less people. I mean, when I bought my first, that condo back in 2004, I was, 26, I think, maybe. Yeah. 24? I don't even remember.
Wait, are you saying 24? You meant
age.
Oh, age 24. Yeah. You were doing good.
Which, we're here in the Midwest. Home prices are significantly cheaper than they are in other areas, so that does help. But, it is different now, and rates are, of course, so much talk around interest rates. 6%, that's kind of where rates are at now, maybe 6.5%. And, we're talking, I was in the 5s in 2004, and Steve, you were in the 6s in your first purchase, and Bill, you were higher than that. So it's not like we've all had this low rate environment that we've all benefited from. Not to say that we haven't benefited, but it's just, rates are probably more normal than they were historically, at least in the last 15 years.
That's right. And a lot of those buyers, Matt, are, they could be downsizing, right? That could be what's causing folks to be a new home purchaser. It could be a downsize.
smaller home, maybe same
More
or higher
money.
price.
More money.
It doesn't necessarily mean cheaper.
That's right. That's right.
Or it's retirement, like what do they call it? Where,
like the villages down in Florida.
yeah, and like everything's included, all the exterior stuff, things like that.
Yeah. Maintenance provided type thing.
That's right. Yeah.
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 And so I think it's good to talk about that because, why does 50%, and that's just Matt and I's estimate. I bet we're probably pretty close.
Yeah, I would agree. Yeah.
Why does the 50%, I'm not saying there's anything wrong with either. There's not necessarily a right or a wrong, but when you look at your total situation, you have to just look at your balance sheet. You look at your assets and you look at your debts, and you just want to be a prudent steward of your balance sheet. So having some debt going into having a mortgage, it's fixed most cases. I would bet if I had to put another percentage on how many of the 50% clients we have that have mortgages, how many of those are fixed compared to variable, I would tell you 99% are fixed mortgages.
Yeah.
Right. So there's no surprises with a fixed mortgage. But yeah, as long as it makes sense, and we'll go through, I think, what we hear today, some of the reasons why you might carry a mortgage and why you might decide not to.
Exactly.
Yeah. Well, I think a good first question on that angle is, can you even get a mortgage for example, if you're in retirement and your only income, let's say, is Social Security, and maybe you're getting income from your investments, but you don't have like a steady job type W-2 paycheck. How does that work in retirement? Because I know, as you guys know, I'm sure as all the listeners know, like if you've gotten a mortgage in recent years, it's like there's so much paperwork you got to fill out. There's so much income verification. There's so much, all your investment statements and everything that you have to send away, and they look at all that stuff. And it's a little bit different if you're in retirement. You don't have a steady income like that. So how do they look at that? Is that a problem?
No issue whatsoever. And as much as we've gotten away from, I think, some of the lax mortgage lending policies from the period prior to the great financial crisis,
right?
Because back then there was a lot of what do they call them? Like that. I've heard the term ninja loans. No income, no job,
no doc loans.
You can get whatever, but hey, you just tell us what you make, and that's fine.
Stated income, no doc. Those were the terminologies. Stated income. That's what.
And they were negative amortization, meaning your payment was less than what you were supposed to pay, which they were fine with because they just kept tacking more onto the balance that you owed. Those really do not exist anymore. I mean, I don't know of any lenders that offer those things. However, lenders still are pretty, I would say generous with, hey, you have this much income. Because if you go to a lender and say, hey, I want to pre-qualify, they're probably going to tell you can qualify for a mortgage that's more than what you think you would qualify for. And it's, they look at the income ratios to debt, and they look at all your credit score and what fixed payments do you have, and they have basically a formula. And if you don't have a lot of other debt, then you can qualify for a pretty big mortgage. Doesn't mean you should get a mortgage that size, but you can qualify for it. Now that's, this is looking at your traditional W-2 working person. Now in retirement though, they still, Social Security to them is just as good as a paycheck. That's fine. Pensions, same. If you have an annuity or even retirement account distributions are completely fine.
Yes.
You look at your tax return, they show up as income.
Yes.
They have no issue with that. And part of it is, well, one, because you do have, you have the asset base to support the income. And they aren't necessarily like looking at, some may, but they aren't looking at your account balances and saying, well, that account balance is going to run out or anything like that. They're just really looking at your tax return and what's the source of the income. They don't like it when someone just unexpectedly shows up with a big down payment out of nowhere. Like, well, where did that come from?
Yeah, we'll talk about that when we get to talking about the giving your
children.
Those can
happen. It's just don't have it be a surprise to the mortgage lender or to the underwriters, because really it's like you got two people. You've got the initial mortgage lender or the person you're dealing with that's helping you get the rate and kind of help with all the paperwork and everything else. And then it goes to underwriting, which is where they then scrutinize everything. And they start asking more questions if they see anything that they need to. But we have not had clients have any issue whatsoever get a mortgage when they don't have W-2 or self-employment income. Of course, self-employment income sometimes can be more difficult than a W-2, but when they just are on Social Security and distributions from their retirement accounts, no problem. And it's common for us to also write income verification letters.
That's right.
Which is us just stating, hey, they are receiving this amount of deposit dollars every month deposited from their accounts that will continue, on and until whatever. I mean, they usually again don't need a hey, this is going to be paid off or guaranteed because they have the collateral. They have the home. The home's the collateral.
That's
if anything were to happen. I mean, the homes don't get up and move. It's like they know where the house is at.
That's right. And we share on the program a lot. We have 20 financial planners here, Matt.
Yeah.
20 credentialed or on their way to credentialed financial planners, and so we do a lot of training. One of our key core values here at Keene is we're always learning. You're always growing, always learning, and always wanting to be better. And I mean, really, you have to continue to stay on top of all these things. So we have some of you have been to our office, seen our conference room where we're able to, it's way bigger than the boardroom, seats like 60 or so. It's really nice. In fact, we just had about 3 weeks ago, we had one of the local most well-respected tax and legal firms here doing their continuing education here at our office. We had about 27 lawyers, tax lawyers, and CPAs doing continuing ed. And our planners were also sitting in on that with those folks. But so it's very powerful. The brain trust is very powerful. And I was sitting in that meeting and there was a mortgage lender. And I say that meeting, they happen all the time, but there was one specifically that also led to this episode, really, along with the other listener questions. A mortgage lender, a very, very sharp mortgage lender, was here presenting to our planners. This was different than the tax firm that was here, different meeting. But they were sharing, and I was listening to our planners, Matt, our planners, talking about what they've had to do, the different ways they've had to income verify for various clients over these past few years even. And it was different. So depending on what bank you go to, or if it's a Fannie Mae loan or not, there's different requirements for your income verification. They have something called the recurring distribution qualification, some of which you could just take a letter from us that just shows that what you could be taking.
Yeah.
Others required that you actually did take the money out of for instance, an IRA that showed 1099 income. Others that just required us to show what you could do based on an asset depletion schedule, which is where you take, in that case, actually your assets in a specific account and a certain number of monthly payments and show that, got to kind of verify that. So there's different ways. So if you're out there right now looking to get a mortgage in this time where you are retired, you might want to give your planner here at Keene a call and just get a sense for which bank and which ones we've dealt with, which lenders and what they require. If you have one of your own, that's okay. Just you can actually put them in touch with us or collectively, and we'll make sure we get you what you need. What we don't want to do is force payments out of an IRA account that you didn't need, pay taxes on those just to prove you could. So in those cases, it might make sense to look for a different lender that requires a different verification process. But there's more to it than you might think, I think, is what I wanted to share. But it's all very possible.
Yes.
Very doable.
Yeah. And age is not a factor. That's another common concern as well. I'm in my 60s or in my 70s. No one's going to lend me money for 30 years. And it's
30 years,
again, back to the fact that the house is securing the loan. So there is that concept. And but two, there are rules. The Equal Credit Opportunity Act, you can't discriminate based on age. So they can't just, hey, you're too old for a mortgage. We don't think you're not going to outlive this loan. So they can't do that. As long as you can pay the monthly payment based on their underwriting standards, that's really all they care about.
That's right.
Yeah. What about if you want to pay cash and not take a mortgage? How do you think about where does the cash come from? Which accounts does it come from? Think about if you're going to convert some IRA money and now you've got income and that may tie into IRMA surcharges. How does that all work? How do you think about all that?
Yeah. I mean, really, it's like we run all the numbers, and one, it's like first step is let's plug in everything into the financial plan, and okay, let's make sure we can afford it first and foremost, and then okay, that's all good. Now let's figure out how to pay for it. And if someone has the bulk of their assets inside of a retirement account, so it's pre-tax money. So when it comes out, you're going to trigger taxes. We just go through the tax. Hey, here's the tax calculation. So if you're looking to clear $500,000, you might have to take out $700,000. When you start framing it that way, so it's like, so this house is now costing you this today versus, yes, a mortgage, if you were to live, over the period of 30 years, you're going to pay interest, but it's over a period of time, not coming out today. And then to your point, Steve, what else in terms of not just federal and state income tax, but there's other surcharges, other things that come into play. And so many times when we go through that, folks then start to think, okay, so maybe a mortgage would make sense. And then we'll run scenarios. Okay, well, let's just look at it paying it over 5 years or 10 years. Like let's spread out the tax liability, not just pay it all in 1 year.
Take your 30-year mortgage still, get the lowest payment.
Pay more.
So it'd be the lowest payment you have to make.
Yes.
But then just pay more. Like Matt's saying, pay more. Let's run it. Let's say, maybe we pay this thing off over 7 to 10 years as opposed to 30. But not all at once. So we call that the brute force method. Yeah. Where, what'd you say, Matt? If you needed $500,000, you'd have to take out like $800,000 to clear $500,000.
Yeah. I mean, it's like, it depends. And two, that's just to get the mortgage out, plus tax what you're already paying in taxes on everything else.
Yeah. A lot of people don't realize when you take money out to pay tax, then you have to take money out to pay tax on the tax.
Yeah.
It's kind of a little bit of a cycle you get into there. So some people though really feel like they want to be debt free, and I understand it. But when you run the numbers and you say, show me how the numbers look, you still have the money. You could choose to pay it off anytime you want. You could choose to do that. You just don't maybe have to do it, or you certainly wouldn't all at once.
Yeah. And two, there's the opportunity cost too, because okay, the money that went out to pay the taxes, well, that could have been invested and what's the long-term rate of returns that the funds have been earning. A lot of times it's still, even at a 6.5% mortgage, still much higher than that. So it's not guaranteed, but at the same time, let's just understand what we're giving up to what we're gaining to, and figure out the best solution.
That's right. And it is. Remember we said, I said up front, we're thought partners with people.
Yeah.
We are literally thought partners. So sometimes there's what the spreadsheet says, which you can start there. And then there's what makes sense for each individual family, and not just one spouse, but both. And the overall plan, the estate plan, the other assets. There's so much more to it than just, a decision in a vacuum. Yeah. And then having folks be comfortable and able to sleep at night with their decision.
Yeah. Because the spreadsheet is almost always going to tell you to take a 30-year mortgage. I mean, that's what the numbers would tell you.
Yeah, unless you're just assuming some really small return on your investment.
I'm only going to keep it in cash and not even earn interest on it. It's like, okay, well then just pay cash for it. But
yeah, because all you have to do is mess around with the inputs on your financial planning model. You could, like Matt's saying, raise the mortgage up and reduce what your opportunity cost would have been had you left the money invested. Although if it's coming out of an IRA, man, it's still going to be hard because all that tax you get crushed with. But you know what? I would say, okay, here's another estimate of the 50% of the people that we work with, the clients we work with that have mortgages. I'm going to say probably about 80% of them, 70 to 80%, have decided to do something in the middle that we're describing.
Exactly.
They put way more down than the 20%. Yeah, maybe put 50% down or something, and then choosing to pay that other 50% off over 5 to 10 years or something.
Exactly. Yeah,
that's where they most land. Most of them land there. But if you own a home and you're trying to buy a new home, and you don't want to feel like you're pressured to have to make the timing work exactly right. So you don't want to think, oh man, we have to sell this house and we have to buy this house and ours has to sell. So they start
line up the
panicking and
closing, contingency offers, things like
yeah,
that.
lowering your price because you think you have to be out of it. There are ways we see quite often, which is either using a bridge loan or having a HELOC on the departure home so that you're not panicked having to sell them at the exact same time. There could be a 6-month or 10-month or 12-month time lapse. Oh yeah, you'd have 2 houses for that time. You plan for it in your budget, but it's not necessarily something that you have to have nailed down and have stress around. And I don't know if we have even time on this episode, or if somebody has a question, maybe they could call us with us on the difference between a bridge loan, an actual bridge funding, and a HELOC, on your prior home. There's a little bit different, and some banks work differently some people are building homes. So there's a construction loan.
That's right.
That works somewhat differently, and you make draws on the construction loan. Then that turns into a permanent mortgage, and you recast the amortization based on what you've decided 15, 30 years, whatever that might look like. So but there's all these things we're trained in and understand the logistics to. And actually, we have some great mortgage lenders too that we refer out to that we trust as well.
Lots of solutions, basically.
That's right.
Yeah. And I think one of the things that surprised me about all of what you guys were talking about there was the median age of the the first time home buyer, and then the second and third time repeat home buyer. And a lot of people in their 50s and 60s are buying homes. Now, maybe that shouldn't surprise me, but just the magnitude of the numbers I thought seemed high, or at least higher than I was expecting. So, so let's
Steve,
flip this.
Wait a second now. You just bought a house out there where you're located.
And one of those stats.
Yeah. How old were you thinking?
I guess I was 62 when I bought that mortgage. So was that like right at the number you were talking about for repeat home buyers?
Yeah. See,
what was that number? I'm a stat. Okay. I'm just like an average stat.
Once again, Matt's data is pretty much right on point.
It is. It's spot on. So let's look at another angle of this question. Not the older person buying the home, but now you've got the kids that want to buy the home. And I think you said the median age for the first time home buyer, did you say that was 40?
40.
Okay.
Wow.
And of course, home ownership is, that's a big issue these days, and just how expensive it is to purchase homes. And so we've got parents and grandparents that are perhaps gifting or coming up loaning down payments, that sort of thing. So what do you guys run across there when it comes to the parents? How should they think about, well, I want to help my kids, but at the same time, I don't want to ruin my retirement plan either. Or maybe I do. Maybe I'd rather delay my retirement so I can help my kids, or maybe I'd take less of retirement so I can help my kids. I mean, everyone, has a different way of how they think about that. What do you guys see there?
Yeah. Well, we commonly talk to clients about this, and a couple of different factors that come into it. It's, again, let's plug everything into the financial plan, and let's just understand what does this do to your plan. And hey, some clients are okay if that puts their plan at more risk, so to speak, than as confident as it was prior to it. They'd rather see their kids do certain things that they can help them with. And again, completely fine with that. But let's understand that first. And then, okay, where do we get the money? Because it's the same tax question if it's coming out of an IRA. Now, it may be less dollars because if it's just a down payment, not necessarily purchasing a home outright, that can be significantly less dollars, which means less tax. But again, still an issue when you have to pay the tax. But really where we see the most common solution is gifting dollars to the kids using the annual gift, exemption. So right now, the exclusion, I guess, is really how they call it. The 2026 annual exclusion is $19,000. So what that means is a parent can gift a child $19,000 without filing a gift tax return. It doesn't trigger any tax, because that's always the question. Well, outside of taking it out of your IRA, which you have to pay tax to do, giving money to your children doesn't trigger it. It's not taxable to them. It's not taxable to you, that concept of it. And if you're married, you and your spouse can gift each child $19,000. So that's $38,000 that, a parents can gift to a child. And then if the child's married, you can gift it to that person too. So right there, between those four $19,000 gifts, you can give $76,000 without even having to mess with the IRS. And again, it's not taxable. It's just a form. It's just paperwork, which is a pain in the neck. But
709, Form 709.
Yeah. And because you can gift right now, the rules are, you can give $15 million away with no estate tax. So all they care about is when the dollars get big enough, IRS wants you to track how much you've gifted towards your $15 million.
Yeah, really, it's a lifetime exclusion.
Yeah. That's all they care about. And that's all for ultra high net worth people, because they're just thinking, okay, well, if they're giving money away and we don't have a way of knowing it, they're going to get out of this estate tax. So, and that's on an annual basis, which is a calendar year. So in December, you could give this example where it was, four $19,000 gifts. So, and then in January, you can do it again.
It's 152 if it's a married couple you're giving to.
Yeah.
Your kids, 152,000 that you would have to track.
Wouldn't even have to tell anybody.
Yeah, the only thing you'd have to do is if that deposit down payment shows up in a bank account relatively quickly.
Yeah, I think they usually ask for 3 months or so bank account statements. So
they do, and if it's sooner, the bank will simply require you to put a letter together that says this is a payment or a gift that is forgiven and will not be asked to be paid back. And the gentleman that was just here talking a few weeks ago verified that with me, that you can give money, because I remember, quite a while back, it was like you can't just show up in your account from your parents. They're going to look at that. But now they're saying that it can, as long as there's a letter that states, maybe this is different from lender to lender, that it's a gift that was not going to be paid back.
Well, I think they've realized this is probably happening more and more. So why are we penalizing people for giving us down payments? Let's make it easier.
Yeah, they can do some business. It's real money. It's not anything. So
yeah. So that's the most common way. Another way that we have some clients that have done this, because they look at it and say, well, I don't necessarily want to, my children to have to pay a high mortgage rate. So is there a way I can figure out how to, loan them the money? And yes, you can do that. There's 100% no issue with that. The biggest thing you have to be aware of for the IRS to consider it a loan and not a gift is you do have to charge an interest rate. And what they suggest is you use they publish federal rates every month. Mm-hmm. And they just say use the correct federal rate. Which right now they have a long-term federal rate 4.92%, which is less than the 6, call it 6.5 a mortgage would be.
Yep.
So you can get online and you can just do a loan amortization calculator and say, okay, what would be a 30-year mortgage with this interest rate? What would the payments be? How much is going to principal? How much is going to interest? All that. And you can do that and be the bank. One downside is you're not helping your credit score or the children's credit score in that situation, if that matters to them, because this is kind of off the books, not reported to any of the credit bureaus. But outside of that, no issue with that whatsoever. Now, you got to make sure you do it, because if the IRS ever asks you about it, okay, you got to prove it. Meaning you have to claim the interest on your tax return as the person who loaned the money. That's taxable interest to you.
Yeah, and if your kids were itemizing and you actually do it right,
they
would be able to deduct the interest if they're itemizing, right?
Yeah.
They'd be able to deduct the mortgage interest even if they're paying it to you, if it's done right. I mean, get with your own counsel. We have counsel we could refer you to as well, but to make sure that's done correctly. And I would say one more thing, again, in alignment with being thought partners and helping clients in each individual situation think through not just the dollar signs and decimal points, but the reason they may do this or not. An intrafamily loan, if they wanted to have their, where it's documented, They wanted to have their kids. They felt they were in a position where they wanted their kids to feel like they had some skin in the game, some responsibility. They didn't want to make it too easy. I mean, everybody, I mean, most people that we talk to here at Keene, most people say they grew up with nothing. It was tough. It was a struggle. They started from nothing. And in a lot of cases, including all of ours, guaranteed, our kids have grown up probably a little easier than we have. No, we've done well. And our kids are, at least, I think our kids are self-sufficient. I know I'm grateful and blessed that mine are. My 3 older ones that are out in the workforce, they don't need me, but they'll never need me more. I say that a lot on here, where they don't need me to live. They could be fine without anything I did for them financially from this point forward. But when I do something financially for them, it's as helpful now as it will ever be, because they're just going to keep getting stronger in their financial planning. I'm very proud of them for that. But some people say, well, look, let's do an interfamily loan. So they feel like that they have some responsibility, and that there could be a factor there as well.
That and even from an estate planning standpoint too, because now this can happen when you have multiple children where, okay, one child doesn't need anything. They're fine financially. And the other one, you want to help with the down payment just because they aren't able to afford it. And you can update your estate plan to say, okay, I've given this money to this child, and kind of have an offsetting one, or like this loan is an easier way of doing it, because it's like, well, this loan exists. It would come out of their portion of the inheritance so that all things are equal. Cause that's a common concern for a lot of people, just making sure everyone's treated fairly, which isn't always equal, but they want to make sure it's, documented correctly.
That's right. That's right. It's funny. My kids, I don't think they listen to the program. I give them trouble. We got almost 300 episodes now, so I wouldn't expect them to. So, but I use them as examples. It's kind of funny. At one point they were teasing. Okay. I'm seriously, they were teasing. I'm really grateful, but my son was getting pilot lessons, right? So he was out ahead of his piece of his inheritance, because he was getting pilot's license, but he graduated from college with his commercial rating, and he's got an incredible job in aviation with Garmin here as an engineer, also coming out of Rolla here. But so he put it to work, right? And then my other daughter was going through med school. Now she pulled out getting ahead of if they were keeping track, right? But
well, you are, Bill, right? You're keeping track.
I'm doing a decent job of it, but the main thing is, the main thing is they're all doing great. So, and I got 5 grandkids now too. So that's priceless, right?
That's right. Yeah.
One thing I think we should talk about on this, and I know we're getting close on time, but I think the thing that we really try to steer clear of, because it is in line with, is it an outright gift? Is it an interfamily loan? Some people have come in and we're considering co-signing or co-owning a property. And we've shared on our other episodes on estate planning and titling of assets, how we really like to stay away from that.
Well, co-owning, because you can add someone as a co-owner on a piece of real estate or an account anytime you want. And what happens is then you lose the step up in basis when you pass away, because the co-owner, it hasn't passed away. So they're not benefiting the same way as if you were to just transfer things at death. And so that's the same on, co-signing on a loan, because your name's going to be on the title too, along with the mortgage company, but you're on the hook if the kids don't pay. And now, it's just like, well, is that a situation you want to be in? Is that the only solution? Again, let's figure out better solutions if we can.
Yeah. I mean, there's some unique things that happen. I mean, there's somebody could trip and fall, or there could be some incident where an owner of a property is getting some liability, and then it flows through to a co-owner
who's got the biggest pockets.
And if there was a large settlement or something that happened that was accidental or whatever it was, that person that co-owned could now have all their assets on the line as a co-owner. See, listen, now it's not just that asset. If somebody's being sued, they could also look at that other person and say they're liable. I'm not trying to go scare anybody here.
Those are risks that didn't exist if you weren't a co-owner.
That's right. That's right.
I'm going to throw in one other thing here and inject an idea here. Maybe there's some politicians or legislators that are listening to this episode. So we've got this thing called a QCD, a qualified charitable deduction. So, you guys tell me if this is incorrect, but I believe that if you are over 70 and a half and you're taking your required minimum distributions, if you take those out of your your qualified accounts and you send them directly to a charity, then you don't pay any tax on it, and that counts as your RMD. So you avoid ever paying tax on that money. Am I correct so far?
For the most part.
For the most part. Okay. There's some nuances. Okay. Maybe it's 73, whatever. They changed the age.
But you can still do it at 70 and a half. So
yes,
that
you can.
concept's the same. Yep.
Yeah. Okay. So what if we came up with an alternative version of a QCD and called it a qualified child deduction, where we want to encourage home ownership? That seems to be a thing that both political parties can agree on.
Oh, yeah.
So why not take the same concept as a qualified charitable deduction, make it a qualified child deduction where you can give your RMD to your children as a gift if it is applied towards certain things like down payments on a home, and you can verify that. So just like we have, the HSA accounts, we have the Trump accounts, and we've got these different things where we've got different ways to fund things to try and encourage behavior that the country believes is actually, encouraging the kind of things that we want to see. So just throwing that out there, maybe somebody will listen to that and pick up on that idea.
Sure.
I love it.
Yeah.
I love it. Well, Steve, you literally have just missed the primaries. Yeah. I mean, you would have had to have already been running your campaign here.
Yeah. It's too late for that, Steve.
Well,
I like the idea, though. No, I actually do like the idea. And my mind instantly starts saying, there'll be phase outs, this and that. But everything starts with an idea.
An idea.
Start somewhere.
What if?
That's right.
Yeah.
That's right. I love that.
Great.
I really do.
The National Association of Realtors and all the mortgage lenders would love that.
Oh, they'd be behind that 100%.
Yeah.
Yes, they would.
For sure.
Yes, they would.
All right, guys. Well, we will wrap it there. Appreciate you being here as always. And for each of you listening, if you would be so kind as to help promote the program and like and share it on your favorite podcast platform, or if you're on YouTube watching it, make sure that you subscribe to it. Please tell all your friends and colleagues about the show. We'd love to get it out there into more people's eyes and ears. And we just appreciate y'all being here. And if you have any questions that you'd like us to answer, you can just reach out to us directly at keenwealthadvisors.com. And we love doing the show for you, and we'd love to make it even more personalized to any questions that you have. So keep the questions coming, and we'll catch you on the next episode of Keen on Retirement.
All right. Thanks, everybody.
The Steve Sandusky Advisor Network and Belay Advisor are not affiliated with Keen Wealth Advisors. Opinions expressed by Steve are his own and not necessarily the opinions of Keen Wealth Advisors. Keen Wealth Advisors is an SEC-registered investment advisor. Advisory services are only offered to clients or prospective clients where Keen Wealth Advisors and its representatives are properly licensed or exempt from licensure. The contents of this podcast are intended for the residents of the United States of America. No advice may be rendered by Keen Wealth Advisors unless a client service agreement is in place. This program is intended for informational purposes only and should not be construed as advice on or a recommendation of any particular investment, strategy, or as tax or legal advice for your specific situation. Keen Wealth Advisors is not a tax or legal advisor. To determine which investments may be appropriate for you, consult your licensed professional prior to investing. Information in this program was compiled from sources believed to be reliable. Due to the constant state of data changing, we do not guarantee the timeliness or the accuracy of the information provided. Our views or opinions at the time you are listening to the podcast may be different than they were when the podcast was recorded. Past performance is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any prices that are referenced or market forecasts are as of the date stated and are not necessarily our opinions moving forward. As always, please remember, investing involves risk and possible loss of principal capital. This podcast is not allowed to be copied, distributed, published, or reproduced without permission from Keen Wealth Advisors.